Well, speaking of the sell-off, some analysts are telling us that parts of the negative sentiment came from China and a report that the government is abandoning large-scale stock purchases. That has yet to be confirmed, but what is clear for all to see is that the Chinese government is spinning the stock market sell-off by arresting journalists and others for alleged online rumor mongering. In fact, one local financial journalist forced to confess on state media. The reporter apologized for causing panic and disorder in the stock market and inflicting huge losses on the country. The statement, "I should not have published a report that heavily and negatively affected the market at such a sensitive time. I caused such great losses to the country and to stock investors. I am deeply sorry." With me now, money managers Scott Lee Munson. Can the Chinese government, Scott, scare people from selling? What does that do to U.S. investors, if anything?
Well, I think they're already trying to do that, Deirdre. I mean, this intimidation, the force that they're pushing on their own people, on their investors, on their journalists, is scary. It's very anti-free market. It's very bad for the markets long term, and it worked for a while. I mean, if you look at the Shanghai Composite or the Shenzhen up until, say, April or May, it probably looked pretty amazing, right? I mean, it reminded me of, say, the NASDAQ run in the late 90s, but then everything kind of is coming back to earth, and I think the government is showing their true colors via their intimidation. And so what's happening is, if you're an investor over there, I feel for you because it's a dangerous game to be playing. And then if you're in the United States, like we have done, as I've told you prior, we've pulled our money from China directly. As far as anything that was involved in indexes over there is now gone because I just don't trust it.
So, Lee, picking up on what Scott just said, let's just even put aside this concern about freedom of speech or how journalists can and can't function in various countries. Scott just said something. It can work in the short term, these measures, but not in the long term. Is that your take as well?
Well, yeah, I mean, we have to remember, why is this story so important? Why are the three of us talking about this right now? Because we have to somehow, rectify why the second largest economy on the planet is less than 2.5% of the global stock market. They don't match. So you've got an immature baby market, and then you have these nannies coming in. We're horrified by it, but we have to remember, this is a brand new, brave new world over there. Less than 10% of the population of China actually owns stock versus over half in the US. So it's a very small stock market, a big economy, and I don't think this is going to end anytime soon. But the idea that everybody's pulled their money out is ridiculous. For everybody buying, there's somebody selling. We're in emerging markets long-term for our clients because they're a great inflationary hedge. So I think you just have to be careful about how you rebalance and don't just jump into it just because the U.S. stock market went down 10%. I would expect more of this control going forward. That's why we discount emerging markets. You don't pay the same amount for Russian equities because half of it's being stolen.
All right, hold those thoughts. We are going to talk about market controls as they relate to our own market, so stay there. Scott Martin and Lee Munson rejoining us in just a few minutes. Compare that message, what Peter was just talking about, to what several former Fed presidents told us last week.
I don't think I can ignore the events of the last couple of weeks, but I think I have to evaluate them as a risk to the economy.
We remain, I think, below what we can be in terms of employment. So I think there's room for improvement both in terms of prices and employment.
Given what we've seen recently, I think we just have to wait and see. I don't want to take too much signal from something that could turn out to be noise.
Scott Martin, as promised, and Lee Munson, as promised, back with me. Scott, what's your take? I mean, it seems like no, and then, well, maybe.
Yeah, if the market goes up 100 points or 200 points on the Dow, yeah, maybe the Fed's back in the game. And then if it goes down, they're not. I mean, I think this is crazy. To think that there's this much dissension on the Board of Governors right now just tells you that they should not be raising rates. I mean, things should be certain. I agree with what Mr. Fisher said, but I also think that things should be a little more certain. And don't forget, yeah, 2% inflation. They used to target 2.5%, but they cut that because inflation numbers were so bad. I think you got to be certain before you put a rate hike on the table here, which I think will be disastrous for stocks if they do it next month.
Lee?
No, I disagree. I mean, I understand what Scott's getting at, but here's the bottom line. We've got to have some ceremonial quarter-point hike, so if we hit some recession next year, we've got something to cut from, because nobody wants a QE 2016. So I think the best, I mean, come on, nobody likes that QE stuff because we can't see it. It makes it harder for us to trade bonds. I think the best thing the Fed could do is raise rates next month in September, and it's not going to blow up the market. In fact, I think the market would rally on it because people would say, hey, things aren't that bad. The Fed felt that unemployment was good enough, on trend, inflation lackluster, but employment's where it's at. If they don't, then it signals one thing, that we're weak and that we need to keep sucking off of mother's milk called the Fed. And I think that's bad for the economy. It's going to make the hangover worse.
Lee Munson,
Yeah,
well
that's good.
argued. Scott Martin, well argued. And as we heard Stanley Fischer say, we could conceivably raise in September. That's not to say we will. So good couched language, as always, from the Fed. Thank you both.